really, at the end of the day, it comes down to figuring out what your goals are and mapping a plan of action to it. You want to own $1 billion in real estate. Well, you shouldn't be buying single family homes. If you want $5,000 a month in passive income, that might be 20 single family rentals. So you should set a goal over the next couple of years to go and hit that and be intentful and really map all your actions to that.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 226. When David Toupin was last on this show, he was well on his way to real estate success as a co-owner of a $7 million portfolio and 120 units, plus a successful single-family fix and flip business. Well, at some point, David invested in a Rocketship because his momentum since then has been stratospheric. Today, David is a top millennial real estate investor, speaker, and entrepreneur. He co-founded Obsidian Capital with our previous guest, Glenn Gonzalez, and he's acted as a key principal with over $50 million in real estate holdings, and he's raised well over $10 million in capital. David also has designed and developed a best-selling multifamily deal analyzer, and he's used that as a platform to found a new software company called Real Estate Lab. David's also a good friend and a great guy, so I'm excited to have him on the show. David, welcome back.
Thanks, Brian. I appreciate that. What a great intro.
Someday you're going to have to give me a ride on that rocket ship because when we talked, it's had to have been 2 to 3 years ago. You had definitely developed a portfolio and you had some success, but you were still pretty fresh to the whole business. Since then, you've left Detroit, you've moved to Texas. You're living large down there.
Well, I've got an extra ticket waiting for you, man.
Yeah, well, good. I want to ride on that rocket ship. So let's give everyone a ride on that today. Tell us just kind of where you are today, and we'll kind of go. I did the same thing with Glenn. We kind of started where he is today, and then went back in time to where he was and how he got to where he is today. And I want to do the same with you. It's just Where are you today? What are you up to? And we'll take it from there.
Yeah. So today, man. So I'm co-founder, like you said, of Obsidian Capital with Glenn Gonzalez, who is an awesome business partner. We are based out of Austin, Texas now. I've moved from Michigan, where I'd grown up, and I'm 24 and bought.
You were 24 the last time I talked to you.
I think I was 20. Man, I had to have been 22 on that podcast.
Okay.
22. Yeah. I've done about soon to be 750 apartments, a little over 500 right now. We're under contract on another 230. So doing a new development. We're doing a ground up development deal here in Austin, about 50 apartments. And we're building a corporate office for our company, ground up. So we've got some land and we're doing some developments out here.
Thank you for bringing us up to date. Now let's go back in time. When we last talked, you had some stuff going on in Detroit. You had a different partner at the time. I mean, how did things change so quickly?
Well, I'd started off, I was in college, right? And I'd bought, with this other partner, I bought a couple properties, about 120 units. And they all performed very well, but we just didn't really see eye to eye anymore on where we wanted to take the company. So we decided to sell everything off. And I had kind of spent that was early 2018. And I'd spent some time in 2018 really figuring out how I wanted to launch kind of from there. I had created some level of success with the apartments I bought. I'd created a pretty good network. I had a lot of people trying to hire me and I didn't want to work for anybody else.
When you say you spent a lot of time trying to figure out what the next step was, does that mean you were sitting in a coffee shop staring at the walls or like how did you
no, man.
How did you figure it out?
No, I was still hustling the whole time looking at deals. So that was right around the time, honestly, that I joined Rod's mastermind with you. And so that's actually where I met Glenn at the first mastermind. And so I'd really just continued looking at deals, continued talking to brokers. I had a couple interim sponsors lined up still, and people that I could partner with and that could, raise equity if I were to find a deal. And it was about a 6-month period. I didn't buy anything from when we started, when I separated with my first partner, up to the point where I had met, was it Tim and Tom Black? Which I believe you met in the Vegas mastermind.
Yeah.
And I actually was working with them for a little while, underwriting tons of deals with them. And we partnered on one in Atlanta. That's 108 units that we bought together. And then shortly after that is when Glenn and I decided to work together. So we had a discussion. We went out to a couple conferences together, and he had found a deal. And we decided, hey, let's trial run this before we partner fully. Let's individually partner on this one deal and see how it goes. And that was kind of the discussion, and it just went really, really well. We worked super smooth together, had a lot of fun. Everything just lined up. He liked the way that I was very organized and really just handled the transaction start to finish. Raising capital, everything. And so we decided to start Obsidian Capital together after that. That was late 2018.
Yeah, and that was a pretty big leap for both of you, because you actually left your home in Detroit and moved to Austin, Texas.
Yeah, it was. I didn't really think I was going to be moving from there, but the opportunity presented itself, and to work with a guy like Glenn, who's owned a massive 4,500 unit portfolio of apartments, it was totally worth it for me. So it was a big leap, but I'm glad I did it.
I know you sort of touched on this, what Glenn saw in you, but I want to dwell on that for a moment. It sounds like you had helped Glenn out a little bit. You had a little bit of a working relationship, but he saw enough in you to say, hey, come join me. Let's do this together. What exactly did he see in you?
It's funny. I was looking at this the other day. He just finished his book, as you guys talked about in his podcast. And
and when we talk about Glenn, it's Glenn Gonzalez. His episode came out just previous to this one, and he wrote the Maintenance Man to Millionaire.
Yep, exactly. And he's just got a great story. So he had told me about that book. Originally, it was in Vegas. I mean, this was almost 2 years ago. He told me about wanting to write a book, and people had been kind of telling him, hey, you should go write a book, but he didn't take the step to do it yet. So after we had hung out, him and his wife took me to a show in Vegas after that conference, or Rod Peace Mastermind. And it just went so well. We all got along really well, and we saw eye to eye, kind of morally, ethically. We were both high integrity people, and that's important for us in a partnership. And so I actually went home and spent all night photoshopping a book cover for him. I took a picture of him and his wife, kind of photoshopped onto a cool book cover, Maintenance Man to Millionaire, and sent it to him and said, hey, don't use this as your actual book cover because I'm not a professional, but here's some inspiration to get you kind of amped up to go write your book. And I actually posted about this on Facebook the other day. Got a ton of reaction, and he just loved it, and he loved my ambition and hustle, and the fact that I was just willing to provide value, no expectation in return. So when we went and did that first deal together, the way he'll tell the story, he always says verbatim, he's like, Dave walked circles around me when we bought that deal. So I just took charge and showed him that, I know how to buy multifamily. It's what I do, and we'll work well together.
Well, what does that mean? I mean, you know how to buy multifamily, you walk circles around him. I mean, Glenn's an experienced, not just investor, but maintenance man. I mean, he knows inside and out. So what did you bring to the table when it came to looking at these properties?
Yeah, I think my big value, I'm super detail oriented and organized, and I really understand the whole process from start to finish. Whether it was getting the purchase agreement negotiated, I played a big role in that. All the way through to aligning up due diligence. We had great synergies. He had a lot of the contacts, and I I'd kind of organize it and coordinate them going out there for due diligence. He did a lot of the stuff with the management company, but I lined up and worked with a private equity firm that funded the whole deal. And so coordinated that and lined up the whole financing. I brought a lender contact of mine and we got a great loan on that. So really did a lot of that, the financing, equity raising, structuring, and he just loved that. It was really all kind of done and he didn't have to think about it much. So, it allowed him to focus on, preparing and lining up that deal, to be taken over and operationally taken care of. It just kind of worked out. Really good synergy.
Yeah, that sounds like a great mix, and I can imagine how relieved Glenn was to have those things taken off his plate by someone who he could trust would follow through on them.
Well, that was the interesting part. I don't think he really knew at first. He actually just tried to hire me on that deal. He was like, "I'll pay you, a couple $1,000 to help me through this transaction, and we'll see how it goes." And I was like, "Well, with all due respect, I'm not interested in working for hire, but I'll partner with you if you want." So we partnered on it.
And was that before you moved to Texas or after?
That was all before. Yeah. I hadn't moved to Texas till several months after we closed on that first deal.
A lot of people to make that kind of move would have to have some sort of certainty. Like they're going to have a job and they're going to make so much money a year, but that's not really how our business works. So I'm wondering what was the situation? Did Glenn say, "Hey, I'll pay you and make sure you have enough to live on"? Or was it all based on let's do deals and you'll live off the money you make from those deals?
Yeah, it was all let's do deals. At that point, I'd already made money from several of the deals we'd done, acquisition fees, and I had some good passive income from the apartments I owned back in Michigan, which I hadn't sold at that point when I moved. So I was fine and comfortable to live on my own moving down there. And Glenn and I had this. I had moved after we had discussion and started to set up our business, and had visited Austin a couple times. So came down a couple times, met with him, met with some of the team members that we would ultimately have, and then really just took a leap. I trusted in him. He's a really good guy, and he trusted me. And for me, it was like, you got to take risks,
Did you have a backup plan in case it all fell apart?
I always kind of have backup plans. I can't remember what it really was at the time, but I had a lot of people at the time that wanted to hire me. I had 3 people offer me north of $150,000 to $200,000 salaries, multifamily companies that wanted me to be their acquisitions lead. And because they'd kind of seen what I had done and like that I was a numbers guy. So I wasn't worried really in the slightest because I knew that, which I never would have done, but worst case, I had a fallback.
So at this point, a lot of people would be saying, well, wait a minute, you turned down $150,000, $200,000 a year so that you could have equity in properties that you may never end up buying.
Yeah, exactly. Yeah, a lot of people thought I was crazy. I remember I counseled with some of my friends and family. It's like, what do you guys think I should do? Some of these people have seen my success and they want to pay me these huge salaries. And I never wanted to. I didn't want to work for someone else. I'm okay taking a risk. I'm even though I maybe made less that year, I knew that the next year and the year after I'm going to make double, triple, quadruple that. So which has ended up happening. It's a patient game. And for me, it's paid off significantly by rejecting short-term money for long-term.
And it sounds like, just in talking to you and Glenn and knowing both of you, that you guys work great together. It sounds like a perfect fit. But I imagine there must have been some challenges stepping into that role as his partner at Obsidian Capital. What were some of those challenges? We
get along very well. Super great synergy because I do a lot of things he doesn't want to do, and he's very good at a lot of things that I'm not particularly good at. So honestly, there weren't a ton of issues, and I think that's what happens when you have like the right partnership. It should kind of flow pretty well. So biggest issue is always for us finding the good deals.
Deal flow.
Deal flow, but we've got a pretty good deal flow, and So it's definitely going well. I can say, because I have had a bad partner before, that if you don't feel great in the partnership, then there's normally issues, because and I think communication is what a lot of times sends it spiraling downhill. And then also, if you don't have the same alignment on your values, if you don't have the same values with your business partner, you're going to make decisions that really rub the other person the wrong way. If you have good values, and you avoid making certain decisions because of that, the other person's going to be like, put off, and which is not right, in my opinion. And they're going to make bad decisions that the person with good values might not like, and it just doesn't sit well.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Give us some examples of how decision making can work in a good or bad partnership, and also how communication works.
Communication, I think, first of all, is just hugely important. I mean, when you're in a business, it's like, I haven't been married yet, but I've been told it's like a marriage. So you really have to make sure everything is clearly communicated. Spending money, what types of, how you're going to foster certain relationships. I mean, I had issues where, partner was making, is kind of an emotional decision maker, and would blow up on people and kind of fire off in emails and stuff, and really burn bridges with people like brokers that you can't do that to. And that is hurting my reputation at that point. And so I couldn't sit right with that anymore. And you have to kind of act on the, same page with a business partner for it to work out.
You have to have the same perspective on money and how to spend it and where to spend it.
Totally.
It's like my one of my partners says to me, he says, you want to make sure your partner's not going to end up pissing all over their feet.
Yeah, exactly. They have, it's important. It's really important to be on the same page there. So, and if you're not, it's just never going to work. And everyone will always feel like they're being mistreated or not heard, or you just have to be on the same page when you have a good business partner, right? So we've been partners for a little over a year, and it's been really, really positive. Everything.
Were you deliberate when you became partners in defining what your role was and what his role was?
Yeah, we were pretty deliberate. I mean, we talked, and we kind of just know what we're each good at. So, but we've divided up different things around the company in terms of, who handles the accounting stuff, who handles more operations, who's acquisitions, and we've kind of fallen into our respective roles. But there's also a lot of crossover, so it works out pretty well. What's
the one or two tasks that both of you hate doing and you fight over who has to do it?
It's weird. I don't like operations and asset management, although I've done a lot of it in the past, and he's very good at it and likes it. So he kind of handles that. I handle most of the acquisitions, underwriting, and then we kind of review deals together when they're at the table. Oh, there's little things like, this is funny. So Glenn likes to be very involved even in little things. And I tell Glenn, I'm saying, Glenn, you are very experienced, and you have certain things which are the best use of your time and certain things which aren't the best use of your time. So things even like setting up an LLC, I'm like, I'll handle that so you don't have to worry about little things. But he loves doing little things like that a lot of times. So it's funny. I've been flow, but trying to get him to focus on just best use of his time. But he also likes being kind of, in the dirt and doing a lot of those little tasks. So he's always got an eye on what's going on, which is a good thing too.
Glenn was telling me in the conversation I had with him that for every 100 deals you guys look at, maybe 10 of them you take to the next level and put an offer in on. Actually, it was more like 1% you actually put an offer in on, and then it's not, so you're not even getting 1% of the deals you look at.
We'll offer probably on 20%, 25% of them, but we'll buy, we're buying 1% of the deals we're looking at. I think 2019, we looked at 400 deals. We underwrote almost, 150 to 200 of those. We offered on 80 to 90 deals, and we bought 3. So, 3 out of 400, that's 0.75%.
And we're recording this late January of 2020. You guys are going to be closing on a portfolio in Michigan.
Yeah. So off market, found it from a mailer, it's an original owner. It's kind of, I don't have it under contract yet. It should be this week, so I can't give too many details. Mm-hmm. But it is a north of 200 unit portfolio in a really cool area, class A and B type infill downtown areas, and we're buying it. It's the original owner who built them. So our favorite type of avatar for a seller is, original owner, or you've owned it for a long time, long-term tenants in there, hasn't raised the rents at all. The rents are anywhere from like $100 to $200 below without doing anything. And some of them we could push them $500 a unit with a renovation. So it's a very, very strong value add, but they're also in really good shape. So it's not beat up too bad. So it's kind of a perfect play.
Well, that's great. You used a term in there. I want to make sure everyone understands. You said they're infill. What does that mean?
Yeah, infill. So any type of real estate that is in a central business district, which is really, any town you've got with like a main street, you've got your retail, shopping, and some multi-story, more dense, higher density type of downtown areas. That area and all the surrounding we call infill. And I believe the reason it's called infill is just because, properties are so tight, so dense together, you're kind of filling in gaps, right? If you find a piece of land, you could fill it in pretty tightly, like property line to property line. And so just call it infill type product.
And you're doing a development deal too. Tell us about that.
Yeah, so I'm excited about that. We bought a piece of land several months ago, and we're building about 60 apartments on there. And so we own land free and clear. It's fully entitled. We got it entitled. Architectural is ready to go. And we're going to start the process for a HUD loan here very soon. And that is about, because we already have the architecturals, it's about a 7-month process, but it could be anywhere from 7 to 10, 11 months to get a HUD loan. And the terms are phenomenal on HUD loans. You get up to a 40-year fully amortizing loan. So it's a 40-year amortization, 40-year term. And rates are sub 4% right now, like 3.8, I think.
Wow.
A couple of years interest only. And it's one loan. You don't need a bridge and then a permanent loan. It's just one loan from the start for the construction. Super attractive. 83% loan to loan cost.
That does sound great. And I guess it helps that you own the land free and clear, so you don't have to shoot for a closing date.
Exactly. Yeah. It's been good and bad. I mean, it's been good because we don't have a carrying cost. It's been bad because there's nothing really pushing us to do it very, very fast. So we've prioritized a couple other projects before this, but we're getting the ball rolling on that right now.
Tell us, why 60 units? Why development? I mean, you've had so much luck just buying existing properties. Why did you decide to build new?
It's really market dependent. I think, first of all, Austin's it's in our backyard. So, I live like less than 10 minutes from where this property is going to be built. And so does Glenn. And in Austin, which, this is not true for somewhere like Michigan or Indianapolis or Columbus, Ohio, for example. But in Austin, pricing is so incredibly high. on B and C product apartments, which are rare in the first place to be able to find for sale here. People are paying anywhere from $110,000 to $150,000 a unit for 70s product and 80s product.
Wow.
We are building all in with land, entitlements, and everything, $135,000 a unit for brand new product. So we're building this for the same or almost cheaper than some of the 80s product and 70s product that is selling here. And so that to us was like, wow, this makes sense. Brand new. And we're going to be just as much as what they're paying for 40-year-old product.
You're building at how much per door?
135 all in. So the
that's
construction, construction itself is about 105 a door.
I mean, that's a pretty good price to build at. Is that because you already own the land and you're not including acquisition cost of the land?
No, that includes the land. And the reason why it's cheaper is we're not building Class A fully amenitized product. We don't have the swimming pool and it's not high end. We're building, I'd say more of like a Class B type.
Workforce housing type?
Workforce housing. Mm-hmm. Yeah. Where the rents in the Class A stuff are, $1,400 to $1,800 in this area, we're going to be $1,100 to $1,250. So we'll be a little below them. Not as nice of a product, but we'll still have, a basic stainless steel appliances and a thin granite countertop, some vinyl flooring, but it's not going to be as high end as other stuff in the area. But we saw a gap. We saw a definite gap, and there's no product like this being built right now. So we are going to fill that need, and a lot of people that don't want to pay for the Class A stuff will fill up here.
And are there any grants or any incentives that you're getting to help you build this because you're building workforce type housing?
No, not at all. No, it's still it's still fully market rate. There's no subsidized housing or anything. So it's all just our choice of product. We're getting lower rents, but we're building it for less. So it's all pretty relative.
If you're doing 60 doors at about, what'd you say, 130 a door,
mm-hmm.
then it's about a $9 million project.
Mm-hmm.
Once you have it built and leased up, what do you think it's going to be worth?
5 cap, probably add another 3 to 4 million on top of that.
That's very promising. You think you'll do that again?
It should be worth about 180 to 190 a door when we're done.
You'll have to come back and tell us more about that when it's all done.
Yeah, I'm excited. It's our first new development, but it's we own the land already. We've got a great builder lined up, and it's not huge to the point where it's going to cause a supply issue in the submarket or anything. It's only 60 units. It's going to fill up very quickly.
As if you don't have enough on your plate already, you're also starting a new business, aren't you?
I am. Real Estate Lab.
Now, this is a software company, so it's a little different. Why don't you tell us what Real Estate Lab is?
Yeah, so Real Estate Lab kind of spawned from this deal analyzer. It's a multifamily analyzing tool that I've built over the past couple of years. Starting from my investment banking jobs I did in college, I really got good at Excel. And so I built this Excel tool that helps you, which I believe you might use sometimes, right? I think
I've used it. It's very good. I saw one of your earlier versions and I was just completely impressed. Found it pretty useful. Yeah.
So a lot of people have felt the same way, and word of mouth, I've sold over $50,000 worth of a spreadsheet in the past 12 months with zero marketing dollars.
Explain what it is and what it does. It's a spreadsheet for analyzing what?
Yeah, so it's a spreadsheet for analyzing multifamily properties. So what us in the industry and anyone who wants to buy an apartment complex as an investment property, you need to run numbers on it to figure out what price to pay. And that's all made very simple if you have a good tool where you can plug in your rents, your operating expenses, your financing structure, what type of loan you're getting. And then it also helps split it up if you're bringing investors in. It splits up if you want to give them a preferred return or a certain cut of the profits. You plug all these metrics in and then kind of back into your purchase price based on what your return, what your ROI is, what your return on investment is. And so this spreadsheet I had no intention of selling it. a couple of people saw it and they're like, "Hey, I'll pay you for it." And I figured, okay, might as well throw it up on my website and see if anyone else wants it. And I've had just word of mouth, a ton of people buy it and are using it now and love it. So what I've decided to do was I'm taking all that money and I'm putting it into building a software out of it. It's going to be a subscription-based online platform with a bunch of additional automation coming into play. You're going to be able to upload financials from a multifamily property in any format, PDF, Excel, your T12, which is your multifamily financial statement, and a rent roll, which breaks down all the tenants at the property, the rents, the number of units. And it's going to automatically pull the data out of those documents, input them into the analyzer, which is in your web browser. And then you're going to be able to go in and put some more assumptions in. You could have preset assumptions so that it speeds it up. It automatically puts them in for you. And then it's going to show you right on your screen, what your returns are, and as you adjust it on the fly. So I'm bringing more technology and automation to the process to help speed it up and give people a more accurate view and what they should be paying for properties.
Okay. How is it that someone can upload a PDF financials and have it automatically populate into the software?
Man, I have no clue, but the tech people, I've hired a software development company out of Michigan, actually Royal Oak, Michigan, and they're doing a great job. So they're doing all the coding, they're doing all of the back end, all that stuff. They're building it from scratch, and so you'll be able to upload it. It's going to recognize the file format, read the text, break it down into our standard format for each of these documents, help you kind of sort out erroneous numbers and categorize things, and then it's going to put it right into the analyzer for you and save you about 10-20 minutes there, and then also give you a bunch of data like what are your average effective rents currently, are there any large outstanding numbers on the T12 that might be CapEx or they're a little bit erroneous. It seems like in May there was a huge amount for the water bill. Why was that? It'll highlight that for you. So it's going to do a couple of different things and really just help you automate that process. And it's going to be affordable too. So I want anyone to be able to do it.
That's really incredible, and it sounds like it's going to highlight discrepancies for you.
Yep.
I look at a lot of pro formas where the expense ratio on an apartment complex might be 35-40%, and right there, that's just a red flag. It's like, okay, you're not going to run a B or C property at 35-40% expense ratio. Does it catch things like that? Yeah,
eventually. Not right from the first start, but within a year, I'm going to have it to the point where it will I'm going to collect data from all the deals being analyzed. And let's say you analyze a deal in Dallas, it's going to say, hey, we've had in the system, we've had 500 deals underwritten in Dallas that are C-class properties. I see that your underwriting is 70s deal in Dallas. We suggest that you use this set of operating expenses for each category. And so it's going to actually suggest operating expenses. If you underwrite a deal with, 40% expenses and it's a 70s deal, it'll say, hey, we suggest you're in the 48 to 52 range because that's what most properties are at. So eventually it will have all this data and it'll truly automate that process once data is being collected.
That's a fantastic product. Is that going to be like a subscription service, or how are you going to roll that out? It's
going to be subscription based. You're going to be able to make a free account and use the entire analyzer start to finish for free. If you want to do more than one deal, you have to pay for it. So if you want to do a second deal, you got to delete the first one, and that's how it's going to work. I want everybody to be able to use it for free, but if you want to actually use it, and you want to save the deals that you're looking at when you add another one, you're going to have to pay for it. It's going to be, I believe I'm going to start at $99 a month. For that, and then there's going to be business versions. So haven't fully ironed that out yet, but it's going to be launching summer 2020.
How much per month?
$99 a month.
Yeah, I'm sure it'll be worth it for those who are actually buying and making offers on large apartments.
Oh, absolutely. I mean, it's going to be an essential tool for people. almost like CoStar, the commercial real estate software, which my company pays $1,400 a month for. So this will be a very essential tool for anyone that wants to buy multifamily properties.
Yeah, and having a good analysis software in your toolbox when you're buying any type of real estate, that's invaluable. It's worth the investment.
Invaluable. Absolutely. There's a lot of error that comes into play. Human error when underwriting, or spreadsheet error. I've seen people who have gone, and I saw a friend who lost $150,000 a couple months ago. They went under contract and lost that in earnest money and due diligence costs because the underwriter that they had hired, it wasn't a principal that was underwriting the deal. It was a non-employee outside for hire underwriter who claimed to be a good underwriter. He had an error in the spreadsheet that said it was at like a 16 IRR. And when they consulted with us, I pointed this out, and it changed it to like an 11. And they were overpaying by $500,000, $600,000, and they couldn't renegotiate, and they couldn't raise the equity because it was a bad deal. They were overpaying, and so they lost money because of a bad underwriter and a bad spreadsheet.
It sounds like they were a little suspicious, and they came to you to get some consultation.
Yeah, well, they weren't. I mean, they went to a couple private equity groups or funds that normally will put money into that type of deal, and all of them turned it down. And they came to me, and I was like, "Wow, that's because you're paying too much for the deal." I knew it right off the bat once I saw the deal and the price, but then I looked into their underwriting. They're like, "No, but the underwriting looks great." And then I pointed out an error, and they ended up, unfortunately, they lost quite a bit of money. So having the right tool is important, and that's what I aim to build for the people.
What are some other mistakes you see people make that good analysis software like yours will help prevent?
I think on the human error side of things, just projecting too high of rents. If you're expecting to get $1,000 a month where they're currently at $700 for renovating the unit, and really you can only get to $900 a month. That extra $100 times 100 units is over $100 over 100 units. It actually comes out to, I think it's about $2 million in value if you're at like a 6 cap. So they're over projecting by $2 million in value on the back end, and that might show them a really good return on their money. Where in reality, they're only going to hit 900 rent, maybe. And then they don't have that $2 million in value. They sell the property, and they're not making nearly as much as they thought. So, when you're making a purchase price decision based on a lot of these assumptions, you have to be using the right assumptions, conservative and accurate.
One of the other things I want to talk to you about, because I know you're very tech savvy, and one of the things that you do that I don't see too many people doing it, but you're doing, I'm seeing it more often, is just really using social media as a platform to put yourself out there, keep people in the loop as to what's going on with you and your investing. And I'd imagine it helps bring in potential investors with you as well.
Social media has been massively helpful. It helps build a ton of awareness around me and our company, and drives a lot of people to sign up on our website to be investors. I think I've raised well over $1 million from people just that I've met and built relationships with through Facebook and Instagram. And this next deal that we have coming up, we've got to raise about $5 million. I think half of that will come from people that I've built relationships with through social media, or that's where the initial contact was. So it is massive, and I know it's only going to continue to grow and grow and grow.
How do you go about building relationships through social media? I mean, are you taking it off of the Facebook and Instagram and like getting into phone calls and face-to-face meetings, or I'm just curious how you build those relationships? Yeah.
So, I mean, as you know, and I'll explain to some of your listeners, for us, we raise capital when we buy these large apartment buildings. We do syndications. And so to do that, to qualify, according to the SEC, you have to have a pre-existing relationship, and they go into kind of define exactly how you can build that, right? But you have to have multiple touches, contact with people, conversations. So Facebook a lot of times is the intro, or where people, Facebook or Instagram, people will hear about me, have a message conversation. They'll go to our website, sign up, learn more about us, learn more about our process. And then I'll get on the phone with them, and we'll have several conversations around their investing goals and how we would be the right sponsor for them to invest with in one of our deals passively. So really, it's the social media is the point of contact, and then we bring that conversation to email and phone. And then a lot of times in person, I'll meet them at events or around town if they're local. I'll meet up with people that I've met through Facebook or Instagram, and it's just it's been a great source for us. So I'm only continuing to grow that more and more.
Yeah, and you're doing a good job at it. And you posted something the other day that I thought was really interesting, because a lot of times when you see people post on Facebook, it's all rah, 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 everything's wonderful. But you posted something about insurance rates in Texas going through the roof. Share a little bit about that with us, because I thought it was pretty interesting that you posted that.
It is. Yeah, it's crazy insurance going on. So I think, so I've talked a lot with my insurance provider about this. So many different insurance markets have pulled out of Texas, and providers have pulled out of Texas. I think the hurricanes a couple of years ago that were big in Houston, that probably played a decent amount into this. But what it seems like is a lot of the data through technology that they're now getting is really suggesting that and showing them that they're just they haven't been operating at a profit. They've been operating at a deficit for a lot of multifamily insurance. And so costs have been artificially suppressed for a little while now. And instead of just ramping up their growth rate and doing it over the next couple of years, this year in particular, they are just exploding their rates. And so we're seeing renewals anywhere from 20 to 30 to 40 to 50%. I've seen some almost double. And so, it affects some of our properties. Thankfully, we've bought all our properties at the right prices, and they're, they can easily weather this. However, I think there's a lot of people that did not expect this and did not plan for it and assumed that everything was going to go right. And now that this is happening, it's definitely going to put some people in a tough position, or maybe even underwater on some properties with the insurance costs and taxes. Taxes are really high in Texas. So it does not mean that we can't find good deals here. We're going to underwrite up front. Coming back to underwriting, I'm making sure that I'm talking to my insurance provider frequently when we're looking at deals, so that he's going to give me an accurate read on where our insurance costs are going to be. And same with taxes. We use tax consultants to help us estimate that as well.
As we wrap it up, David, why don't you tie it all together for us? I mean, like you said, you're 24, and you've just, I don't know anyone who is as successful as you are or were at 24. Tell our listeners what it is that they should be doing in their lives to even achieve a modicum of the success that you've achieved.
I think it all starts with like where your goals are at, right? If you want to take the route that I have and skyrocket, as you said, I'm proof that it's absolutely possible that anyone can do it. It really, at the end of the day, it comes down to figuring out what your goals are and mapping a plan of action to it. You want to own $1 billion in real estate. Well, you shouldn't be buying single family homes. And so that was my goal. And that's why I switched and started going really big. If you want $5,000 a month in passive income, that might be, 20 single family rentals. And so you should set a goal over the next couple of years to go and hit that and be intentful and really map all your actions to that. And so everything I do every single day is just another step to map me towards my goals and our company goals. So you got to hustle, man. It's a lot of hustle.
Yeah. Well, that's definitely something you're good at. How would people get a hold of you if they wanted to?
Yeah, best spot is on Instagram at Real Estate Jedi. You can find me. Or you can check out our website, obsidiancapitalco.com.
Well, David, it's been a pleasure talking with you again. Just hearing about everything you've been doing in the past 2 years since we talked makes me feel very lazy and like I've accomplished nothing in my life.
That's okay.
But I'll deal with that with my therapist. But anyway, it really has been a pleasure, and I always enjoy catching up with you. And, seeing you when we get together at the Rod Cleef's multifamily boardroom and, just paying attention to what you're up to on social media too. So thank you for doing this. And I think you've provided a lot of inspiration for our listeners.
Thanks, Brian. I appreciate it, man. Thanks for having me on here and looking forward to seeing you soon.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.